Suppose we are expecting total revenue from the project, we're expecting 500,000, and total expected costs from the project are 400,000. Expected profit, and it was all based on expectations. Expected profit is 100,000. Now we have choice that we can use either of the three methods: cost basis, sales basis, or physical proportion of work completed. Now that was a company policy that we'll use cost basis as a method for spreading the revenue and cost. Now year one passed. When year one passes, the costs incurred to date, we get to know that costs incurred to date are 150,000. If I calculate a percentage on cost basis, the percentage I'll get is percentage on cost basis will be cost incurred to date compared with total expected cost. Total expected cost is 400,000 unless there is a change into 100. I'll get a percentage. If my company policy is to use cost, 37.5% work is complete. There may be sales basis percentage. Now, according to you, you wish to recognize revenue of, let me make it 1,60,000 to make our calculations a little bit easier. Suppose 40% work is complete. Now, if you're using cost basis as a method, we would like to record revenue and cost of sales on the basis of 40%. 40% of total revenue expected is 500,000. We can recognize revenue of 40% of 500,000 and 40% of 4 lakh. We can recognize revenue till date. So we can recognize revenue of 200,000 and we can recognize cost of 160,000 and can recognize profit in the books for year one at 40,000. But if it was sales basis, the work certified to date, it could have been work certified to date that no, according to us, the work completed is not 40%, and a surveyor will come and will say that no, according to us, the work or cost incurred to you, adding some profit margin to it, we believe that work certified to date is worth only 180,000. If we are calculating percentage of completion on sales basis, then we'll use work certified to date as a basis to know the percentage. If we calculate the percentage on that basis, the percentage on sales basis would have turned out to be, 180,000 divided by 500,000, that is the total sales value, into 100. So according to them, the percentage could have been only 36%. That according to us, you may have incurred a cost of 1,60,000, and according to your calculations, you believe that your revenue is 200,000. But if the company policy is that we'll record revenue and cost of sales on sales basis, because there's always a difference between what actually gets certified and what they actually incur and would like to record revenue. So some of the companies which are sales driven may also decide that they will be recording revenue to be conservative. Being conservative in approach means they'll recognize lesser revenue on the basis of the work certification. They may go ahead with going for sales basis method. Sales basis will be on the basis of the surveyor. They certify the work that in comparison to the total revenue we are expecting, we get a percentage. Is this clear? The third method is that if you have to construct, now if you are not aware, we do not wish to use these two, we can use on the basis of the milestones. Physical proportion of work completed. Suppose there are 10 floors to be constructed, and if 3 floors are constructed out of 10, we can simply say that 3 floors out of 10 are constructed, 30% work is complete. So this is an approximation. So even if there is a difference in two same companies using different methods and recording different revenue and cost, the difference will be very small. It will not impact much as far as materiality is concerned, because more or less similar, ultimately they're going to recognize this revenue and cost over the period of time. So there were only three methods available to us, which was cost basis, sales basis, and physical proportion of work completed. Now we have many more methods. Output method was actually sales, input method was actually cost basis, output method was also physical proportion of work completed. Now we have more methods now that you can use based on inputs used to satisfy the performance obligation. That what are the inputs? Can be labor hours, cost incurred. So we had only one way earlier, cost incurred to date, total expected cost. Now we can use labor hours as a basis to calculate the percentage of completion. The total labor hours to be worked on the project, like 50,000 labor hours. We have completed 10,000 labor hours, so we can say 20% work is complete. Machine hours to be used if it is machine driven work, then total machine hours, 60,000 of machine hours required, and we have completed 20,000 of machine hours. So 20,000 out of 60,000 can give us a percentage. Material used on the project, total expected cost of the material or total material, and how much material we have used till date, total expected material to be used, that can become as a basis. We have more methods, more bases now, which are going to give us fairer presentation. Output method can be on the basis of the milestone, as I said, physical proportion of work completed, or what is the work certified to date, based on results achieved and value transfer to the customer. Value transfer to the customer is the work certified to date. It can be on the basis of performance complete to date, milestones reached, that out of 10 floors, 3 are complete, units produced or delivered. So now we have more basis for recognizing revenue and cost of sales. That's the basic difference between the previous percentages were available with us. Now we have more basis. Is this clear till now? Hello? Is it clear? Any confusion on the basis of discussion which I've done till now? Any confusion? Hello? So the accounting treatment which we were doing for IS 11 construction contracts, outcome can be estimated reliably, outcome cannot be estimated reliably. The same accounting is being done for IFRS 15 revenue from contracts with customers. Only thing is the name has changed. It is performance obligation satisfied over a period of time, but the accounting basis, accounting method remains the same. Now, if it is profitable, we are recording profit. Year 2.
Amit, Bhanu here.
Yes.
I just have, I was looking at the book as well. So there are two things: performance obligations satisfied over time and performance obligations satisfied at a point in time.
Yeah,
so
right.
How do these differ?
I'll be coming to it, Bhanu. So if you notice that I touched upon, there was sales of goods, there was interest, royalties, and dividends, but I picked up rendering of services within it. In construction contracts, I picked up the construction work, and with it, I am relating how the accounting for this is done. I'll be coming on to sales of goods and other areas.
Okay.
Why I continued with this, the reason for continuing with this was that since I was trying to relate with that IFRIC 15, and since I felt that I have almost done a little bit of discussion around it, so I should continue discussing rendering of services and performance obligations satisfied over a period of time. So since I built up the relationship, so I should finish up the entire content relating to it as well. So is the reason I continued with it. Instead of moving on to introducing what is IFRS 15, I'll introduce it to you. So I picked up one component so that at least this gets clear. Okay, I'll be moving on to IFRS 15 yet. I'm simply building up relationships as of now. Okay. So is the reason I didn't touch on the slides of IFRS 15. I took you to the last slide of IFRS 15, which was based on recognition of revenue for over time. If I take you back, definitely we'll be studying both recognize revenue over time versus point in time. Okay. So I have picked up performance obligations over time. So there are definitely two things to it. Clear? So I'm purposely building up on the area which requires recognition of revenue over a period of time. I'm going in a reverse manner instead of going, because doing it purposely, because when I'll take you through the slides, it will be very clear thereafter, because you'll be able to relate to the content. This you already know, but I'm doing it now because this is again repeated in IFRS 15. The accounting treatment is same. As I said, the name has changed, and the name is changed to merge two standards. They had to merge IAS 11 and 18. So to merge, a different name was supposed to be given, and that name is performance obligation satisfied over a period of time, instead of first classifying them as rendering of services or construction contracts and then coming onto the same situation as percentage of completion. So a broader word now, performance obligation satisfied over a period of time, which is able to cover up both the standards and is helping us to merge these two standards together. So as I said, was outcome can be estimated reliably, outcome cannot be estimated reliably, which is no profit, no loss. If we cannot estimate it, there's no requirement for percentages. Whatever cost we have incurred, if we believe it is going to be recoverable, we recognize cost to that extent. Percentage is required when the outcome is estimated reliably. If outcome can be estimated reliably, it will either result in profit, either result in loss. Losses, being conservative, are recognized immediately. Whenever we get to know that this project is going to be suffering a loss, we recognize it immediately. Suppose in year 2, the percentage reaches 60%. So total revenue, total cost of sales, we can recognize till date is, and I believe there is no change in the revenue and cost figures. It may also happen that this will change. This can change because of 3 or 4 things. The total expected costs can change for 3 or 4 reasons. The reasons can be variations, claims, penalties, incentives. If there is a variation, the variation is in agreement with the contractor that we want to vary the drawing room, we want a variation in the kitchen. If the customer wants that variation, definitely the contractor will say that this variation will cost you 1 lakh more. There are some, and if the contractor tells you that it is going to cost you 1 lakh more, he knows very clearly that it will cost him 80,000. So he will know these two amounts, that the total revenue will now increase by 1 lakh and total expected cost will also increase by 1 lakh. So this can change, and the new figures could be these. The total revenue now is 600,000. Total cost will also increase by 80,000 to 480,000, and total expected profit has now increased to 120,000. So we'll not make any changes in the year 1. We'll simply apply the new percentages on these new amounts. So variation is agreed between customer and contractor. Claim is not agreed by the customer. Claim is something which contractor believes that he will demand from the customer, but customer may agree to it, may not agree to it. The customer provided the site late, which resulted in some loss to the contractor because he had already hired labor, he had already hired machinery. The machinery and labor were idle for some time. 15 days of labor and machinery was idle, and he is not responsible for it. So he would like to demand a claim of 70,000 from the customer. Customer may agree to it, customer may not agree to it. If by chance customer agrees to it, but there is no profitability in it, so the cost which has increased because of it may result in a revenue, because total expected costs are also including these claim amounts, and if customer agrees to it, the revenue increases with that amount. Or if that cost of claim has not been included as part of total expected cost till now, it has to be included. The customer, if doesn't agree, revenue doesn't increase. So it depends on what is the situation. So what I mean to convey is that these two amounts can increase or decrease. The total revenue figure can increase. It may decrease by penalty. If the contractor has not provided the site on Diwali or the Shera or Eid or on Gurupur, whenever it was expected, or on Christmas Day, whenever it is expected to be delivered, if it is not delivered on time, and if there is a penalty clause that if you don't deliver on time, you'll have to suffer a 10% penalty. So the total revenue expected by the contractor may reduce by 10%. It may turn out to be 540,000. These amounts may increase or decrease. So the accounting being done in these cases is that it's always on the total. Always on the total. Now, I believe that it was on cost basis, and the percentage is on cost basis. The new percentage on cost basis is now, if we have incurred till date, we earlier incurred till date 160,000. If the cost incurred till to date now is costs, it will always be cost incurred to date plus expected cost to be incurred will give us the total cost. This will become the basis for knowing the percentage. So on cost basis method, cost incurred to date is, I suppose, 300,000. Total expected cost incurred to date plus expected cost to be incurred, I believe it to be 480,000, which gives me a percentage of 62.5. 312,000, I'm assuming, is the cost incurred to date, and gives me a percentage of 65%. So how much revenue I can recognize till date? Revenue, cost of sales, and profit I can recognize till date is 65% of total. It is always on the total. 65% of total. Total revenue to be recognized till date is equivalent to 65% into 600,000. Total cost I can recognize till date is 65% into 480,000. Total profit I can recognize till date is this. How much I've already recognized in year one? In year one, we had already recognized 200,000. We have already recognized 160,000. So this year we can recognize only the differential amount. So why we always apply the percentage on the total? To know how much we can recognize till date, out of which we had already recognized something in year one, we have already recognized something in year two. We'll be successful in recognizing these amounts over a period of 2 years. That's what performance obligation is, being satisfied over a period of time. So we are spreading the cost and revenue over a period of time. Something we have recognized in year one, something we'll recognize in year two. So revenue and cost recognized in year two will be revenue, cost, will be the difference between the two. 390 minus what we have already recognized. Cost will be 312. The total we can recognize till date minus we've already recognized 160,000. So this year we can recognize 190 minus 152. So total profit, if you notice, we have recognized till date is 38,000 this year, and earlier we had recognized a profit of 40,000. How much profit recognized till date? Total profit recognized till date is 78,000. It may happen that the contract may run into losses because of some increase in price. Year 3, we get to know that the contract has actually run into losses. What to do now? The total expected cost and total profitability. Total expected costs have now increased to 650,000. The contract has run into losses. There is an expected loss of 50,000. It says that losses are recognized immediately. So what will be the accounting that we follow now? how much revenue, and suppose we have completed the cost incurred to date is suppose 450,000. And if I apply the percentage, suppose 455,000 is the cost incurred to date, and the percentage of work completed now is 70%. I'll make it more, 5 lakh. Suppose cost incurred to date is 5,20,000 and the percentage of work completed till now is 80% on cost basis. Cost basis percentage is 80%. So how much revenue we can recognize till date? Revenue we can recognize till date is 80% of total, which will be equal to 80% into 600,000. How much we have recognized till date? We have recognized revenue of 390 till date. So this year we'll be recognizing the difference. Revenue recognized this year is equal to the difference 480 we recognized till date minus, either you can take the revenue which we have recognized in year 1 and year 2, or you can directly deduct it from the revenue we have recognized till date, that is 390. 390 was 65% of total at the end of year 2. This is the revenue we have recognized till date, that is 190 in year 2 and 200,000 in year 1. Total 390 we recognized till date. So this year we can recognize revenue of 90,000, the difference which we can recognize. As far as costs are concerned, now in case of a loss, cost now in case of cost will be the balancing figure in case of loss. We cannot apply percentage to it. The reason being, we know the loss to be recognized immediately. The loss to be recognized immediately we know in advance. How much loss we need to recognize? How much loss we need to recognize? We need to recognize a loss of 50,000. Not only this, we have already recognized a profit of, till date, we have recognized a profit of 78,000. So how much total loss we will have to recognize this year? Reversal of the previous credits we have given to profit and loss. We have already recognized profit of 78,000 and we believe that we are going to suffer loss of 50,000 over the period of contract. We need to recognize it immediately. How much total loss we need to recognize this year? How much total loss? So we'll not apply percentage to the cost to be recognized till date, because there is no way we'll be able to justify it, because even if I apply percentage, it may again give me a profit. If I apply percentage on the cost till date, suppose 80% of 650,000, 80% of 650,000 will give me 520,000. Out of 520,000, how much cost we have recognized till date? We have recognized till date 312,000. How much I can recognize this year? I can recognize 520,000 minus 312. I'll be able to recognize cost of only 208,000, which is giving me loss of 118,000, which is turning out to be 68,000, but it's not covered exactly the total loss to be recognized. So this, we do not apply percentage whenever we suffer losses. We do not apply percentage because this is not going to give us appropriate accounting. So how much loss we need to recognize? We need to recognize loss of 50,000 and reverse 78,000 in total. In total, 78,000 plus 50,000. The total loss to be recognized is actually reverse 78,000 and loss of 50,000. Total loss is actually minus 128,000. So we have to recognize that cost of sales this year will be the balancing figure of these two amounts. Minus 128 and 90. What will be the cost of sales? 218,000 will be the cost of sales which we will be recognizing this year to rectify the profit which we have recorded in previous years. Also to recognize the loss immediately. Is this clear? In both the situations, like when there is a profitability, we'll apply it on the total, we'll apply on the total cost. But when there is a loss, we need to recognize the loss immediately. And in that case, the cost will be the balancing figure. If we have recognized any profits in previous years, those need to be reversed. If first year we suffer a loss, the entire loss becomes recognized immediately in the year one. But if we have recorded profits, then whenever we believe that there is going to be a loss, we'll have to reverse the profits which we have recognized in the previous years. Is this clear to you?
Sir, एक doubt है.
Yes.
Sir, year 1, year 2 and year 3, the total revenue is for that particular period.
You're right.
And expected cost also. Then why are we showing incremental, difference between year 1 and year 2 when we are recording it? Because for the period we have actually, for year 1, year 2 and year 2 we have had some profits. So it is for that period.
So it is for that period. So we should see. What is your doubt? That we should recognize, we are recognizing profit on the basis of a percentage till date.
Yeah.
So when it reaches year 2, we say that this is the total revenue we can recognize, this is the total cost we can recognize. If we have already recognized some revenue and cost in year 1, we'll recognize only the differential in year 2.
So
we cannot.
So that means in year 2, the total revenue and total expected cost is till date, not for the year, not for the particular.
Not for the year, not for the year. It's always till date. Is the reason I was stressing on the point that it will always be on the total, 65% of total.
Okay.
The reason being it can change. Since it is being recognized over a period of time, over a period of time means not belonging to one particular period. If we had known that it is at a point in time, there was no confusion. Since that at a point in time is not known, it is over a period of time, the expected revenues can increase or decrease, the expected cost can increase or decrease, the profitable project can run into losses, or it may be halted, whatever could be the reason. Since it is uncertain is the reason we are using this accounting, so that we can recognize something in year 1. So keeping in the concept of cost matching revenues, if I do not recognize anything in year 1, that will also not be fairer because I have done some activity during the year. So how much shall I recognize in year 1? On some estimate. Now these are estimates: input method, output method, cost was basis sales, basis physical profession was completed, are simply estimates. That instead of recognizing 0, if I recognize 200,000 of revenue, which is fairer. This 200,000 is not actual. What actually happens, they'll get to know only when they complete the project, because year 1 seems profitable, year 2 was profitable, and suddenly in year 3 they are a loss-making company, loss-making project. So if they are loss-making, means they know that they're going to suffer a loss of 50,000. Can they live with the profit which they had recognized in year 1 and year 2?
No.
If they cannot, we need to reverse the profit which have already been recognized, and we need to recognize the loss we are going to suffer on this project immediately. That's a requirement of the standard. So we have to reverse the previous loss and recognize the loss immediately, what we are expecting on the project. So the total money which is going to be reversed is 78 and loss to be recognized is 50. So this is going to be the amount of loss to be recognized in third year. Revenue we can continue with the percentage. So this difference is going to be all charged to cost of sales this year, because this is the only way we can increase the cost, by increasing the cost of sales.
Okay, got it.
Or we don't have any other medium to record this, because the loss is fixed. That is reversal of 78 and 50,000 to be recognized immediately. Revenue, we know this is what we can recognize till date. So this is the area which acts as a balancing account for losses.
Clear.
Clear? So
Thank
this is a
you.
situation when we know the outcome, whether it is going to be profit, whether it is going to be, when outcome can be estimated reliably, either profit or either loss. The second situation can be when outcome cannot be estimated reliably. In that scenario, we have no choices. The only thing is we'll recognize revenue only to the extent of the cost incurred. So normally it is no profit, no loss. If there is a doubt on recoverability of this 50,000, then revenue can result in loss. That will not recognize revenue to the extent of cost incurred. Will recognize only to the extent of recoverability. If we believe we are not going to recover the full amount, we recognize only to the extent of cost incurred to date. The same concepts are being used for performance obligations over a period of time. The accounting remains the same. There is no change in accounting. That's what I meant to convey. There's no change in accounting. The only thing is that we have now more methods of recognizing revenue. For recognizing revenue, we can recognize revenue when on the basis of performance obligations. So either it is at a point in time or either at a over a period of time. When it is over a period of time, in one of the following conditions, it is over a period of time when customer simultaneously receives and consumes the benefits as the entity performs. Now this is coming in from rendering of services of IAS 18, but now under IFRS 15 it's one and the same thing. When asset that is created or enhanced is controlled by the customer, this is the construction activity being done. The buyer has control over design and specification. They're able to control whatever is being done on their premises. Vendor has no alternative use of the asset and enforceable right to payment for performance to date. Now, if you have demanded to make a rocket and after the work is complete, you say that I don't need this rocket, what will the contractor do? So this is mainly in case of residential projects or mainly in case of specifications which can only be used by the customer is bound to pay. In such scenarios, if any of the condition is applying, it is a performance obligations being satisfied over a period of time. We do not need to meet all the conditions. If any one, like cleaning services, access to golf or gym, what asset that is being constructed, like on the customer's premises, if something is being constructed and customer says that no, I don't need it, it is either enhancing their existing capacity or it is going to be consumed by the customer only because they're controlling the premises. Building software on customer server, this is being done. Construction on customer's premises. Now the contractor cannot say that no, I'll take away, I'll take back. The cost is done. So it is saying or any of the conditions is being satisfied, it is performance obligations satisfied over a period of time. And how the accounting is done, I've already discussed with you. And these are the methods which are applicable for the basis for knowing the percentages for performance obligations satisfied over a period of time. Hope this is clear.
I
Yes,
have just more going back to the same point. It is in the very first year or the second year we had made a profit of 78,000 rupees, and
right.
we paid taxes on that, right? And then next year we have made a loss. Say it was till date, say 50,000 rupees, and now we have to reverse the entire profit of say 128,000. I'm saying that we have already paid taxes on 78,000 previously. So how the treatment would be, as I understand that we recognize the profit for the year. Now it is for the life of the contract.
So when we were paying, Bhanu, when we were paying taxes, we were not expecting a loss in future.
Yeah.
Now, if we are expecting a loss now, this year will not be paying any taxes on it. and we've already paid taxes relating to this activity. Now, when we are reversing this loss, we are not only reversing the loss to be recognized in future, we're also reversing 78,000. Now, this is also being communicated to tax authorities that the 78,000 which we earned in previous years, we have paid taxes on it, now is going to be a loss for us. Okay. So we'll be getting a credit this year because by more losses this year means lesser income this year. Lesser income this year means lesser taxes this year. So next year automatically adjusted.
Well, I'm just thinking of that. What if there is no other thing? We are just doing one contract at one point in time, and we already have paid taxes on that. So how we are going to are we going to get the credit on that? I believe.
So that is based on. So I'm assuming here that tax authorities gives you credit for losses in future, and they allow this expense. Okay.
Okay.
I'm assuming it that the tax authorities will allow you to recognize this loss in future and they'll give credit for it. When they'll give credit for it, you have paid more taxes in future and you'll get credit for it in future. So automatically set.
Yeah, that is a process for the future, not what we have shown as a profit in previous years and paid taxes over there. Okay.
Okay. Yeah. Since that's what the uncertainty inherent in it, that we are not sure what will be the situation in future, is the reason we record accounting on the basis of what is the situation today and how much work we have completed, how much we recognize revenue, how much cost. In future it may change, is the reason we are always estimating it on the total, and total can change. And the reasons I mentioned, that they can be variations, claims, penalties, incentives. It's not always loss only, it can be incentive also. That if you have given the project on time, the customer may be happy and may give you 20% incentive or 5% incentive. So in that year, revenue may increase. And if your total revenue increases, whatever is the balance gets settled in the final year. So total revenue, if it increases to 7 lakhs, I assume. So whatever you recognize till date, you have recognized revenue of 90,000 in year 3, recognized revenue of 390,000 in year 1 and 2, total 390 plus 90, we recognize revenue. So if it reaches to 7 lakhs, and by chance project may turn into profitability as well, you never know, because of it is running into losses, and there are some measures taken by the management by which they are able to earn that incentive which was too big to cover up their losses. So this loss making may turn into profitability as well in the final year, and whatever revenue you, if it is reaches 7 lakhs, so definitely you'll have to recognize 7 lakhs over a period of time, over a period of 4 year or 5 year. So 7 lakh out of 7 lakh, how much you recognize in the form of revenue till date, the differential you will be recognizing in the final year. How much cost you have recognized till date, you've already recognized a cost of 218,000 in year 3 and recognized in year 1 and 2 160, and the difference is total 312 till date. 312 plus 218 you have recognized till date. Now in the final year, if your costs are too less and you turn into profitability, you will recognize the differential as profitability. Whatever losses you have recognized will be reversed in future because of your profitability in future. That's why they are being spread over a period of time, because there is an uncertainty inherent in it, and this accounting is able to take care of those uncertainties, that if there is a fall or increase in terms of revenue, if there's the cost increase or decrease in future, since it is connected with each other over a period of time, the final year can take care of the settlement. Is this clear?
Yeah. Just one more thing. As in the total expected cost, we have included variations, penalties, claims. So, is there any, if there is any after sales service which we are going to provide uh, after the completion of the project, the contract? So, are we going to include that into the cost as well, or we are going to make provisions for the future?
Depending on whether if it is a distinct product, see after that, if that after sales service is a separate component which is purchased separately by the customer, that will be considered as a separate performance obligation.
Yeah.
Will not be clubbed into it. But if it is already part of it, if suppose if it is already part of it after sales service, then the contractor will have to recognize a provision for those services. There is a liability if it is a standard practice. So on the basis of probability of the cost they are going to incur in future on maintenance or after sales services, since they give it as part of their standard product, it's not being sold separately, then they may have to record a provision that this is the liability which they may have to incur in future. So they have to be prepared for that liability on the basis of probability that this is the cost they're expecting to incur in future. So the management needs to be prepared by creating a provision against it. But if it is a separate performance obligation being sold separately, then depending on their how it is being consumed, rendering of services, kind of against performance obligation satisfied over a period of time. After sales service for 3 years, sold at a price of 50,000. So that 50,000 will be spread over a period of 3 years. Okay.
Okay, thank you.